All right, hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our options trade of the week. Over the past few weeks, we have seen markets all over the map. Volatility is at an extreme, so too are equities, the commodities, the energy markets have been pretty amazing on the upside, and a lot of that is due to the ongoing Russia-Ukraine conflict. Markets, they hate uncertainty, right? And we're seeing that priced into many markets. Oil specifically. No one knows how long this conflict is going to continue on, nor does anybody know how this is going to impact oil supplies worldwide. And we're seeing that reflected in price. You can see at the time of this video, we've got oil futures over here on the left-hand side. You've got oil futures trading almost up at 114, up near all-time highs. You're taking a look at a chart of USO here on the screen. This is the US Oil Fund ETF. This one here also has had a parabolic move to the upside. And I think we're heading towards some interesting levels that we could potentially take advantage of as traders, right? It's so easy to get caught up in the news cycle, right? Financial media and media in general, for that matter, they're trying to get eyeballs on the headlines, right? They're trying to push the whole fear narrative. And it's absolutely an awful situation over in Ukraine. No doubt about it. But we also have to try to block out the emotion as traders and say, okay, how do we manage our risk and how do we make best use of our capital in the given market environment? I think we're heading to some interesting levels that we could potentially take advantage of. So let's talk through a couple of potential charts of interest going into next week. I'm going to walk you through some specific trades that you can take utilizing options. That way you can put on a trade that's fully risk defined. Right? I get it, the uncertainty, people are nervous, you don't know where markets are going to head. We're going to walk through some trades that are going to tie up very little capital, and you're going to know what your maximum loss is right up front, just in case the trade goes against you. Pretty important point there, given the current environment. So looking at this 130-minute chart of USO, I love this time frame. It filters out some of the noise that can kick in on a 60-minute chart, for example. It also speeds it up a little bit compared to the daily chart, so it really identifies the swings well. Now, looking at the histogram down at the bottom, this is what we call our pulse indicator. And you'll see over on the right-hand side, we've got a whole slew of yellow and green bars. What those are identifying are overbought and oversold extremes. In this case, because we have these bars on the upside, they're indicating that price is overbought. Now, what makes it overbought? What goes into that calculation? The pulse indicator is taking a look at standard deviation. And when I see these yellow bars like we have currently, that's indicating that price is between a 1 and a 2 standard deviation move on the upside. In other words, we're at an extreme where only 13.6% of all occurrences fall outside of this range on the upside. It doesn't mean it can't happen. It just means it's not statistically probable. We've already had a heck of a run higher on oil. Could it continue to move to the upside from here? Sure. Anything is possible in today's environment. But if we take a look purely at the statistics, okay, we block out the whole emotional side of trading. This indicator doesn't care that there's war going on. This indicator doesn't pay attention to the headlines. It's focused purely on price patterns. All right. So if I know that only 13.6% of all occurrences fall outside of this range on the upside, what that leads me to believe is that we're probably at a point or close to it, a point of exhaustion where we could potentially see some consolidation or even a pullback, a nice healthy pullback. Doesn't mean the market's going to fall apart. Doesn't mean the bottom's going to fall out, but a pause here for the next week or two, very, very possible. Now, how do I play that? If we see the market overbought and I am expecting this pattern to start consolidating, potentially even rolling over here a little bit, I could potentially buy a put option. The problem with buying a long put right now is if I take a look over at the VIX is above 34. The VIX is giving us an indication of how high volatility is market-wide. When the VIX gets high like this, when volatility gets high, the options are more expensive. If you buy a put option here on USO, you're going to pay a lot for it. Market makers are pricing in that uncertainty. Doesn't mean it can't be profitable, but you're starting to stack the deck against you immediately. What I want to do is put on a more forgiving type trade that's going to tie up less capital and take advantage of volatility being high. So we're going to take a look at selling a vertical spread. We're going to sell a credit spread here on USO. So let's jump over to the trade page and let's take a look at the April monthly options. They have 41 days left to expiration. If I open those up, I'm going to go to the out of the money calls here. And we're going to try to take a look at selling an out of the money call spread. Selling a call spread is a neutral to bearish position. I'm going to go out to the 82 calls. I'm going to go ahead and right click on those. I'm going to go to sell and I'm going to go to vertical. And that's going to pop up an order down at the bottom of my screen where by default, it has me selling the 82 call and buying the 83 call at the same time. I'm going to change the 83 strike to 84. We're going to take a look at a $2 wide call spread. By selling this call spread, I'm ideally looking for the stock to move to the downside. Any type of a move lower from here is going to help me immediately. I just don't need it. If price just consolidates here. If we just kind of chop sideways, I can work with that as well. And even if the stock moves against me, even if we continue to move to the upside, within reason, I can work with that also. So let me bring up the confirm and send box and we'll take a look at it in more detail. If I collect 60 cents or $60 per spread, my maximum profit is $60 per spread. That's the most I can make. If USO completely falls out of bed and trades lower by $15 over the next couple of weeks, the most I can make is $60 per spread. The most I can lose is $140. So now you're taking a look at a bearish position. We're tying up less than $150. And we're going to have a very high probability of success because we have 5 ways of making money on the position. We make money if the stock moves up, down, or sideways, as long as price stays below 82.60. That's my break-even point. That level is calculated simply by taking the 82 call strike, and we're adding on the 60-cent credit that we'd be collecting to put the position on. The stock price is at 78. I can be wrong by $4.50 here. The stock could continue to move to the upside before I'm in trouble on this position. Remember, we already said price was at an extreme. We already said price is between a 1 and a 2 standard deviation move. So only 13.6% of all occurrences fall outside of that range. I have a little bit of a cushion here where this extreme could get even more extreme before I'm in trouble. That's why I like this trade versus just buying an outright put. All right. So again, up, down, or sideways, as long as price stays below 82.60, we make money. And then more importantly, we put time decay in our favor. We know every day that you hold an option, that option is losing value. That hurts you if you're buying an option. But because we're selling a spread here, that time decay every day that passes, that helps us. We make money from time decay adding up, and we make money if volatility decreases. We already talked about volatility being at an extreme. Volatility is high here. In all likelihood, volatility probably going to start settling down a little bit. We could potentially even see it contract. And we know that coming off of a big directional move, volatility can normalize pretty quickly. Any type of volatility contraction also helps us trade. So now, instead of having only one way of making money, if I buy a long put, this trade that I'm looking at here gives me 5 ways of making money. I'm just increasing my odds of success. Ideally, I want the stock to move to the downside. If it doesn't, still okay. If we just kind of chop sideways in here, I'm okay with that too. The only move that hurts me is a big move higher from here, which we're not expecting because oil's already made such an extreme move. Now, how do I manage this trade? If I get filled at 60 cents, what do I do with the position? How do I manage it? What's my target? My target on a credit spread is when I can close the trade out and keep between 50 and 75% of my max profit. My max profit is that 60 cents or that $60 that I'm collecting to open this trade. I would look to buy the spread back when I can close it for between 15 and 30 cents. That would allow me to keep between 50 and 75% of that max profit, all right? So you can go ahead. Lately for me in my own personal trading, I've been targeting 50%. I've been going for the smaller wins just given the back and forth nature that we've seen, these extreme moves back and forth. I've been trying to manage trades faster. So what I would do here is if I were to put this trade on today, I would create a closing order immediately at 30 cents and I would set it to a good till cancel order. So now over the next 41 days, if this spread trades for 30 cents, I've already got a working order in place. That order could be executed and filled, even if I'm not by the screen. If you're busy working, if you're not in front of the screen all day long, doesn't matter. You have that working order in place. So it takes a lot of the stress out of your trading, right? Not requiring an all-day commitment. You're in a fully risk-defined trade. We already know what our max loss is right up front. And the only way that I'm going to lose that entire $140 is if I hold all the way up to expiration. If I close the trade out early, anytime over the next 41 days, I can take a partial loss on the position. So really nice trade to be in. And if you've got a bigger account, if you've got a small account, putting this trade on with one spread, it's $140. I mean, it's pretty reasonable for just about all account sizes, right? If you've got a larger account, this is a pretty liquid product. You shouldn't have any problem getting filled with bigger size. If you put this trade on with 10 spreads, a position size of 10, you still only have $1,400 of risk. And now all of a sudden you've got $600 of profit potential over the next few weeks. See how that starts to add up? We're still putting on a risk-defined trade. We're starting to build that size over time. So I love the trade here on USO. If I were to go back over to the chart here a second, any of the other energy products, Chevron is another one that I like to trade. If I take a look at CVX on that same 130-minute chart, you'll see a very similar pattern. I mean, you're going to see this pretty much across the board on any energy name that you look at. They've all had extreme moves. So again, long term, it doesn't mean that I am bearish going out weeks and months. What I'm looking at is the price extremes in the near term present an interesting opportunity for a potential pause or a pullback. What we just walked through on USO, you could follow that same process here on Chevron. I'm leaning neutral to bearish in the near term, just looking for a quick pullback. Halliburton. Don't quite have the extreme here on Halliburton. This is the type of pattern, though, that I'm expecting over on USO or Chevron. We might not get a huge pullback, but look what Halliburton's done. We just kind of settle into a sideways range here. That would be perfectly fine if that happened over on Chevron or USO. XLE, this is the energy ETF. We're just starting to hit an extreme here today. We're just starting to get a yellow bar on the pulse down at the bottom. Again, indicating that price is at a 1 to 2 standard deviation move on the upside. They're expecting a point of exhaustion to be met here soon, and in the near term at least. And when I say near term, I'm talking about the next few days and maybe out to the next couple of weeks, potentially getting a nice healthy pullback before a next potential wave to the upside. So that's what we're looking at here going into next week. The energy markets are top on my list here over the next couple of days going into next week. I think there's a massive opportunity in the near term. So I'd love to have you join us with the trade of the week. So I'll be back here next week. Make sure you like this video, subscribe to the channel. I'll definitely be posting updates throughout the week next week. If we do end up getting that pullback, that we end up closing the trade out, we'll definitely update you guys here in the channel. So make sure you subscribe, and that way you're getting a heads up on any future videos that we put out. So if you have any questions, feel free to comment on the video, or you can email me directly, mike@netpicks.com. I'd love to connect and help out. So I'm going to wrap this video up here. I'll be back with you guys here shortly with our next video.